Hi, I'm Genevieve Wood and welcome to OpenMarkets TV. Today I'm here with the CEO and co-founder of the Australian corporate bond company, Mr. Richard Murphy, and we're here to talk about an exciting new product that's available on the ASX called Exchange Traded Bond Units, or otherwise known as XTBs, and how this has revolutionised access to the Australian bond and fixed income market for investors. Thank you so much for talking to us today,
Thanks,
Richard.
Genevieve.
So before we get on to XTBs and how exciting this new product is, can we go back to basics and talk about exactly what are corporate bonds?
Sure. Look, companies, when they need to do the business they're in, they need money, obviously, to do it. So they raise capital either by issuing equity, shares, as we all know and love, or they can issue debt securities, or they can use their own internally generated revenue. So when they go to the debt markets, they can either borrow from a bank or they can issue securities like shares, except they're called bonds. So really a bond is a loan to the company. So you lend the company money and it says, right, for lending me that money, I will pay you interest, coupons, and I'll do that every 6 months. Let's say it's 6% coupon, I will pay you 6% per annum. Let's say it's for 5 years, I'll do that every 6 months, and then I'll pay you back the money you lent me. So it's really a loan to the company. So instead of lending money to a bank, you're lending it to a company, and that's what a corporate bond is. So they're traded between, AMP and Colonial will buy and sell bonds issued by Telstra and Woolworths, etc., etc. So that's the corporate bond market, and it's very much a wholesale market. So it's really only the big players in the investment market can buy and sell bonds. You and I, generally speaking, can't, which is why we've come to the market for this particular business.
So what's different about exchange traded bonds, or XTBs, then, and why is it so exciting for investors?
Well, XTBs are exchange traded bond units, as you've indicated, and really what we're doing is saying, well, let's look at the problem. The problem is the big corporates, BHP, Telstra, Woolworths, etc., are not doing a prospectus and not bringing those bonds to the ASX. So regular investors, retail investors, cannot access those bonds. So there are good reasons to be invested in bonds, we'll talk about later, but we can't get access to them directly. So what we're doing is saying, well, exchange traded bond units, we will do the prospectus document and we will list the security on the ASX that gives you direct exposure to, in this case, 17 different underlying corporate bonds by top 50 companies on ASX.
Because up until this point, really, bonds have only been available for more sophisticated investors. So now this is opening up to any investor, really.
Yeah, so it is open to all investors, because you could, if you have a stockbroker or financial planner or an advisor who can get securities that are traded on the ASX for you. So that's the key. You have to really be able to access the securities on ASX. So if you've bought shares or ETFs or property trusts or things like that, then you can get access to these. So it's really giving access to the inaccessible in a format that's wrapped up for regular investors on the ASX.
And so what are the sort of returns we can expect from XTBs?
That's a really good question, and it's one that's worth spending a little bit of time looking at. This is all really about diversification. You shouldn't have all your eggs in one basket. Everybody knows that. Yep. It shouldn't always be about equities alone. Equities are great, but you don't put all your eggs in one equity basket. So this is about the fixed income end of the market. So it's a different sort of return profile than you get from equities. It's not as volatile, and also you don't get 1,000% returns on bonds. So you look at it in that context first, and then you have a look at, well, how has the market gone, say from 1991 through to now. It's quite a long period of time, where we had a look at the performance of the entire equity market, so the ASX accumulation index, which shows the top 200 and all of the dividends put back in, and how has that gone over that period, 1991 to 2015. And as you'd expect, the returns there are quite significant. On an annualized basis, it was 9.9% on an annualized basis. That takes into account the GFC when it fell, and so it really is kind of the average over that period. You look at the corporate bond index and the returns are 7.5%. So not unexpectedly, equities are yielding a higher return of 9.9 versus 7.5. But then you have to look at, well, how volatile is that return? How volatile, how subject to the vagaries of the market and things going up and down in a way you wouldn't like them going up and down too much. And equities, as you'd expect, equities are more volatile. They were 14.5% volatility on an annualized basis, and bonds were 2.5%. So while bonds yielded only 7.5 versus 9.9, they were an awful lot less volatile, and that's kind of what you expect. What that suggests is don't put all your eggs in one basket, either bonds or equities. It says be diversified and invest in both. So that's kind of the general picture on yields. If you look at the actual XTBs, our yields range in terms of yield to maturity between 2.5% and 3.5%. And if you look at total returns, which takes into account capital returns on how the security moves in the market, if we'd had the XTBs for the last year, up until now, then the range of XTBs would have ranged between 10 and 16% return. You've got to be careful with that, though. You can't just keep on looking at total returns on things like bonds, because they do mature, and you've got to realize that they will go back to their par value at the maturity date.
Okay, thanks, Richard. So how do we invest in bonds, or these exchange-traded bond units?
The same way as you would invest in shares. So you go to your broker, a broker like OpenMarkets or financial planner group who goes through brokers and basically buy it like you're buying shares. So you would pay brokerage, and your trade would be settled in 3 days, and your XTBs, just like your shares, would be held in your HIN in Chess.
So what's the minimum investment amount for XTBs?
Well, the bond units, the XTBs, are in $100 lots, but most brokers will say, well, we don't want people buying things in $100 lots, so they'll have a minimum, and for most brokers it's about $500.
And at OpenMarkets, our minimum for a buyout is $500. So then you could actually enter the XTBs at a fairly low cost then.
Well, yes. So there's always there's brokerage involved in buying them. There's our fee, so we charge a fee up front for the cost of running the XTB product. And so the effect of our fee is that if the bond was trading over here in the wholesale market at 3.9%, it will be then trading at 3.5%. So it's about 0.4% loss of return, and that's for the cost of running the XTBs that we have to bear.
So what type of investor are XTBs suitable for? Is there a type of risk profile?
That's very important, the risk profile. It's really, well, what type of investor and within what element of their portfolio. So it's investors that should have fixed income, and that's really everybody should have some fixed income, and the older you get, the bigger proportion of fixed income you should have. But it really, because it's on the ASX, it's open to all investors. It's not an investment for AMP and Colonial, because they can access the wholesale market. But for individual investors, it's those looking for stable outcomes, stable returns, stability of their capital. So they're not looking to, this is not risk money. This is not, I'm willing to have a flutter on a mining stock. This is, I'm putting money into an XTB over Woolworths, and I want that money back with coupons along the way. So it's people looking for stability in returns, self-managed super funds, retirees, people who want to be able to predict that in 3 years I've got school fees coming up, for 7 years I've got school fees coming up, and I need that money. So I want to be able to know right now that here's the capital I have. I need that capital back in 3 or 5 years with returns along the way. So it's much more like, while it's not a bank account, clearly it's not a bank account, it's not like a term deposit in that it's a bank account, but they have similar sort of risk profiles in terms of, well, corporates lending these top 50 companies money essentially is in the same sort of ballpark as term deposits. So the returns are kind of slightly above term deposits because the risks are slightly higher than being in a term deposit.
Right. So you mentioned risks. Can you run us through what are some of the risks? As with any investment product, there's always risks.
Yeah, absolutely. So, and the return is lower, so the risks are generally lower than shares. The number one risk is the way the structure is set up. Your credit risk, as the professionals will say, but really, will I get my money back, is through to the underlying company that issues the bond. So if it's a Woolworths bond, your real risk is, will Woolworths pay me the coupons along the way, and will they pay me back the capital at the end? So that's obviously, when you think about Woolworths and Telstra, you think that's probably a low risk that they won't pay that back, but it is nonetheless a risk. And if XTBs were available on a much smaller company, which they're not, then that risk would be considerably higher. That's the number one risk. When you invest in any interest rate security, there's obviously a risk that the next move in interest rates is up or down, or there is movement. So they are sensitive to movements in interest rates. There's also liquidity risk on the ASX. So will there always be liquidity, i.e. can I buy and sell the XTB on the ASX at the time I want, at the price I'm looking for. So those are really the three main risks. There's a PDS available, obviously, for this product to be issued to investors, and in there all of the risks are detailed.
So is there a place or somewhere we can go to access research or performance reports on XTBs?
There is research provided for the investors, so the advisors to investors, so brokers and financial planners. That research, because of the way it's generated, it's really targeted at the advisor level, so that it's generally speaking not available to the end investor, but it's really to give your advisor the sort of knowledge they need about the product and who we are and the risks and those sorts of things, to give advice on the product. So that's one level of research. Then you can always go onto brokers' websites. So if you go onto OpenMarkets websites, there'll be quite a bit of information about the product. There'll be the PDS available, or at least a link through to the ASX website. ASX then, for all of the products it has in the market, provides quite a lot of information about the product, a level of research as to the historic prices available on the product, and coupons that have been paid, etc., and all of the announcements that we've had to make about the product. And then, of course, there's our website, which has PDS and an awful lot more information for investors to have a look at, to give them a sense of what are the rewards and the risks of investing in this type of a product. So between all of those, there's quite a lot of information.
Now, XTBs, this is something unique to Australia. There are no XTBs overseas, is there?
Not that we're aware of. That we've obviously had quite a good look around the world to see has anybody else done this. In some other markets, so the New Zealand market, they have the bonds directly available on the exchange, because the company in the New Zealand situation has done a prospectus. So you and I could buy them if we were living in New Zealand. But in most countries, they're not available. In Germany, they're available. But in the UK, they're not available. And what we've seen is nobody really is doing what we're doing, which is putting together a security that says, well, there's inaccessible, but these guys want it, and these guys don't want to bring it to them, but we'll bring it to them and we'll put it on the exchange. So we think we're probably the first doing that.
Definitely. And I've got a question about Basel III. And Basel III, it's a big beast, and
Yep.
a lot of us would like to know more about it. Has Basel III affected the timeliness of XTBs?
It certainly changes. Yeah, it certainly changes the game for the term deposit market, and it's a global development. So it's really all about the global regulators getting together and deciding what is the best environment globally for the financial stability of the world's banking system, because we don't want another GFC occurring anytime soon. So part of that is that banks have enough capital and there's enough liquidity in their capital. So one of the outworkings, and it's a very, very broad piece as you suggest, but one of the outworkings is that all banks, and Australian banks, need to look at the sort of terms they offer for term deposits, where people have put money in since the GFC and have been able to access that money just by calling up and saying, look, I want to break my term deposit. I'll lose all of my return or lose a lot of my return, but I need my money now, today. They can't do that anymore. So that has changed things for end investors and for advisors. And the banks have been forced to say to all term deposit holders, look, the global regulators have told us that we have to say, well, if you're going to break, you need to give us 31 days notice. Otherwise, we would breach the rules. So that changes the nature and the structure of what a term deposit is. At the same time, in parallel, the global financial crisis, term deposit rates were getting up to 4%, 5%, 6%, and they have gradually been falling, and they're now less than 3% for some 1 year. You sometimes can get a little bit more, but generally speaking, the general consensus out there in the market is that term deposit rates are falling to 2.5% or even 2.25% at some time over the next, currently now and also going forward, as expectations are that interest rates will be cut again, that the need for all of the banks to have so much retail money has fallen away, so the banks aren't competing by offering higher yields. And then this Basel III change has come in to say, well, also you can't break the term deposit for 31 days. What that means for us is that, well, this product where term deposits are 1, 3, 5 years, corporate bonds and XTBs are 1, 3, 5 years, so people are sort of comparing them, saying one's a bank account, lower risk than a corporate bond. The corporate bond product, the XTB's got a higher return. So it kind of puts that into the frame of comparing those two. and therefore the timeliness is important, because of course with XTBs you can buy and sell on the ASX via your broker on a daily basis,
and being
subject to
now
liquidity.
accessible to all types of investors.
That's right, yeah, and go from there.
And for our viewers and clients, you can find out more information through us by contacting OpenMarkets or visiting our website. We've got a webpage dedicated to XTBs. Thank you so much, Richard, for talking to us today. We really appreciate your time.
It's a pleasure, Genevieve. Thank you.
Thank you, and thanks to everyone for watching OpenMarkets TV.